Today, we are going to talk about the relationship between interest rates and bond prices. Understanding this is key, whether you're just starting out in investing in bonds or looking to deepen your knowledge. Let's start by talking about what bonds are. A bond is essentially a loan you give to a corporation or government, and in return, they agree to pay back the loan amount on a specific date and make regular interest payments, known as coupons, until then. Now, let's look at the relationship between interest rates and bond prices. This is a classic example of an inverse relationship. When interest rates go up, bond prices usually go down, and when interest rates fall, bond prices go up. But why does this happen? It's related to how attractive your bond is compared to new bonds that come into the market. Imagine you have a bond that pays 5% interest. If new bonds start offering 6%, your bond isn't as appealing anymore. So, if you wanted to sell it, you'd likely have to lower the price. On the other hand, if interest rates drop and new bonds are only offering 4%, your 5% bond looks pretty good, so its price might go up. So, it's important for bond investors to understand this because it affects the value of your investment, especially if you plan to sell the bond before it matures. However, if you hold on to the bond until it matures, you'll still get back the full amount you loaned, regardless of interest rate changes, unless the issuer defaults. A couple other terms you may hear about related to bonds and interest rates are yield to maturity and bond duration. Yield to maturity is the total return you can expect if you hold a bond until it matures, and it's a great way to compare different bonds. Bond duration is a measure of how much bond prices are likely to change with interest rates. Generally, the longer the bond's duration, the more its price will fluctuate with interest rate changes. So now, how do interest rates change? There are a lot of factors, though they're often influenced by the central bank, like the Federal Reserve in the US, which adjusts rates to manage the economy. When the economy is strong, the Fed might increase rates, which can lower bond prices. But in a weaker economy, they might reduce rates to encourage growth, which can increase bond prices. Understanding all this is incredibly useful, whether you're investing in bonds or just trying to understand the financial market. It helps you see the risks, especially interest rate risk, which is how changes in rates can affect your investments. The relationship of interest rates and bond prices is a fundamental part of finance and so, important to understand. Grasping how they interact can help you make smarter investment decisions and better understand the broader financial world.